Okay, this is Chapter 8, Part 2. The Kraft-Heinz merger, managerial missteps, and capturing CrossFit business strategic fit. First question you have to ask is, why did Kraft choose to seek a merger with Heinz rather than starting its own food products subsidiary? What are the anticipated results of the merger? And to what extent is decentralization required when seeking CrossFit business strategic fit or cross-business strategic fit? What should Kraft do to ensure the continued success of its related diversification strategy? Moving on, diversification into unrelated businesses. So, evaluating the acquisition of a new business or the divestiture of an existing business. Can it meet corporate targets for profitability and return on investment? Is it an industry with attractive profit and growth prospects? And is it big enough to contribute significantly to the parent firm's bottom line? Building shareholder value via unrelated diversification. So we have one different type: astute corporate parenting by management, provide leadership, oversight, expertise, and guidance, provide generalized or parenting resources that lower operating costs and increase SBU efficiency. Cross-business allocation of financial resources serves as an internal capital market that allocates surplus cash flows from businesses to fund the capital requirements of other businesses. Also, acquiring and restructuring undervalued companies, acquire weakly performing firms at bargain prices, use turnaround capabilities to restructure them to increase their performance and profitability. The path to greater shareholder value through unrelated diversification. So you have three tests in which to take a look at: the attractiveness test, the cost entry test, and the better off test. What are the drawbacks? Pursuing an unrelated diversification strategy, it has demanding managerial requirements, and you better have the right people in the right place. Limited competitive advantage potential, monitoring and maintaining the parenting advantage, and a lack of cross-business strategic fit benefits. Misguided reasons for pursuing unrelated diversification. If you have poor rationales for unrelated diversification, such as seeking a reduction of business investment risk, pursuing rapid or continuous growth for its own sake, seeking stabilization of earnings to avoid cyclical swings in businesses, or pursuing personal managerial motives, these can be rather problematic for the organization. Combination related, unrelated diversification strategies. Related and unrelated business portfolio combinations may be suitable for dominant business enterprises, narrowly diversified firms, broadly diversified firms, and multi-business enterprises. The structures of combination related, unrelated diversified firms, dominant business enterprise, narrowly diverse, broadly diverse, and multi-business enterprises. Steps in evaluating the strategy of a diversified firm. Well, number one, assess the attractiveness of the industries the firm has diversified into, both individually and as a group. Number two, assess the competitive strength of the firm's business units within their respective industries. Three, evaluate the extent of cross-business strategic fit along the value chains of the firm's various business units. Check whether the firm's resources fit the requirements of its present business lineup. 5. Rank the performance prospects of the businesses from best to worst and determine resource allocation priorities. And 6. Craft strategic moves to improve corporate performance. So the three strategy options for pursuing diversification: diversify into related businesses, diversify into unrelated businesses, and diversify into both. Step 1. Evaluating industry attractiveness. How attractive are the industries in which the firm has business operations? Does each industry represent a good market for the firm to be in? Which industries are most attractive and which are least attractive? And how appealing is the entire group of industries? Calculating industry attractive scores and key measures: market size and projected growth rate, the intensity of competition among market rivals, emerging opportunities and threats, the presence of cross-industry strategic fit, resource requirements, and social, political, regulatory, environmental factors, and industry profitability. Calculating industry attractiveness from the multi-business perspective. The question of cross-industry strategic fit. How well do the industry's value chain and resource requirements match up with the value chain activities of other industries in which the firm has operations? The question of resource requirements. Do the resource requirements for an industry match those of the parent firm, or are they otherwise within the firm's reach? Calculating industry attractiveness scores. So evaluating industry attractiveness, you decide on the appropriate weights for the industry. You gain sufficient knowledge of industry to assign accurate and objective ratings, and whether to use different weights for different businesses units whenever the importance of strength measures differ significantly from business to business. And then we have our charts. We take a look at that. And these are some of the other charts we took a look at from the previous chapter. Evaluating business units' competitive strength. Well, how do you do that? Well, it's relative market share, costs, ability to match or beat rivals on key product attributes. Is your product better than theirs? What about brand image and reputation? Other competitively valuable resources and capabilities, and benefits from strategic fit with other firms, other businesses, bargaining leverage with key suppliers or customers, and profitability related to competitors. Excuse me. Excuse me. And we see our calculations here. Figure 8.3, a 9-cell industry attractiveness competitive strength matrix. And we can see that here in the matrix. Your high, low, where does the business fit in by basically looking at the chart and figures from the previous slide. Determining the competitive value of strategic fit in diversified companies. Assessing the degree of strategic fit across its businesses is central to evaluating a firm's related diversification strategy. The real test of a diversification strategy is what degree of competitive value can be generated from strategic fit. Take a look at this chart. Identifying the competitive advantage potential of cross-business fit. And we take a look at the different operations of the business, from purchasing, suppliers, technology, operations, sales, and look at the different types of businesses. And then we can take a look at the chart at the bottom, which will show cross fit. Checking for good resource fit, financial resource fit, non-financial resource fit. Success sequence would be cash hog to star to cash cow, and whether or not, and I think that's the goal of every a combined business startup or whatever, is it going to become a cash cow? Ranking business units and assigning a priority for resource allocation. Well, we have ranking factors. Is this sales growth important, profit growth, contribution to company earnings? This needs to be decided by each individual company and what the priorities are. The chief strategic and financial options for allocating a diversified firm's financial resources. Strategic options: invest in ways to strengthen or grow existing business, make acquisitions to establish positions in new industries or to complement existing businesses, fund long-range research and development ventures aimed at opening market opportunities in new or existing businesses. And then the financial options you have: pay off existing long-term or short-term debt, increase dividend payments to shareholders, they'll love that. Repurchase shares of the company's common stock, they'll love that also, because repurchases generally lead to an increase in the stock price because there's less stock. Build cash reserves and invest in short-term securities. That's also an option as well. Step 6, crafting new strategic moves to improve overall corporate performance. Strategy options for a firm that is already diversified. Stick with the present business lineup. Broaden diversification with new acts. divest some businesses and retrench to a narrower diversification base, and restructure through both divestitures and new acquisitions. Figure 8.6. A company's four main strategic alternatives after it diversifies. Stick closely with the existing business lineup, broaden diversification base, divest some businesses, and restructure the company's business lineup, as I said in the previous chapters. Broadening a diversified firm's business base. Factors motivating the addition of more businesses, the transfer of resources and capabilities to related or complementary businesses. Rapidly changing technology, legislation, or new product innovation in core businesses. Shoring up the market position and competitive capabilities of the firm's present businesses, and extension of the scope of the firm's operations into additional country markets. Divesting businesses and retrenching to a narrower diversification base. Long-term performance can be improved by concentrating on stronger positions in fewer core business industries. Business is in a once attractive industry where market conditions have badly deteriorated. The business has either failed to perform as expected or is lacking in cultural, strategic, or resource fit. And next, the business will become more valuable if sold to another firm or as an independent spin-off. Restructuring a diversified company's business lineup. Factors that drive corporate restructuring. A serious mismatch, too many businesses, too many competitive weak businesses, ongoing declines in market share of major business units, an excessive debt burden, and ill-chosen acquisitions that really just haven't lived up to company expectations. In the illustration of Capsule 8.4, restructuring for better performance at VF Corporation. What are the expected benefits of splitting VF into two separate and independent firms? Why did VF take so long to recognize changes in the industry and the necessity for changing itself? How can internal growth create a lack of strategic fit where none existed before? I thank you for listening.